Hi, I'm Richard Vague with Tycos. Well, it's time to take a look at the stock market again. And as always, debt and leverage are at the center of the story. We use four primary metrics to see whether the stock market is overvalued. The first two, market capitalization to earnings, also known as the PE ratio, and market cap to GDP, are widely used metrics. The third metric, market cap to total debt, is our own, and in fact has proven slightly better correlated than the first two. The fourth metric we use is also our own, and it's the ratio of market cap to the money supply, M2, which is comprised mostly of deposits. While unconventional and not really used by many others, if any, the relationship between these two indicators have the highest correlation of all four metrics. And that's because of the simple fact that the more money there is in the economy, all money comes from debt, and the more money there is in the economy, the higher asset prices go. By all four measures, the market is, shall we say, fully valued, or stated differently, at the very highest end of the historical range of valuation. Note that it is also as high or higher than the peaks reached prior to the stock market crashes in 1929, 1987, and 2008 on most metrics. There's several things going on there. We'll get back to that. We would also note that aside from market cap to GDP, all metrics are considerably lower than the peak reached in 1999, just prior to the dot-com bubble, for those of you who remember that. Just goes to show how much over-speculation there was around the Internet 1.0 boom. We've put a dot over the 2023 value for the values that were in place in 1929. And you can see, particularly as regards valuation to total debt, which is our favorite metric, as high as we are now, we are still below the 1929 level. However, any analysis of stock market valuation would be incomplete without a look at the leverage in the stock market. That's kind of the undergirding or underpinning of any market, particularly a stock market. And we do this by looking at two things: margin debt, which is the obvious one, and equity derivatives, which is a little less obvious. Margin debt to GDP is on the high end of the range, well above 2007 and slightly less than the high of 2017. We can ignore 2020 because the COVID denominator collapse made all those metrics, a little bit non-comparable. In 1929, this margin leverage reached 14% of GDP. Things were very different there then, since stocks could be purchased with only 10% of the money down. The margin requirements were that low. That's why margin requirements were increased in the 1930s to 50%. Now, beyond margin debt, we have equity derivatives, stock futures and options, which are to us a form of leverage and are more troubling to us since they are at an all-time high by far. As an aside, these were all much lower for this metric in 1929. Those types of leverage, futures and options, were far more in their infancy. And so, in a sense, what's happened is folks, large-scale investors in particular, have figured a way around margin limitations by these synthetic means. So it'd be unreasonable, given how high valuations are across the board, not to expect some level of correction over the coming months. But bear in mind that we have had five corrections of 10% or more since the global financial crisis. And the market has regained its prior peak in an average of around 7 months in each of these 5 cases. To us, a correction does not become more problematic unless there is also a contraction in aggregate debt, in particular private sector debt, which frankly is one of the rarest of all events. I mean, it happened in right after 29, it happened in '09, but it's something generally we almost never see. While we're on the subject of debt and valuation, let's take a quick peek at crypto debt and valuations. Though it's all still very small in comparison to the overall market, both crypto leverage and crypto itself, crypto debt, by our estimate, is skyrocketing. Now, this is a very hard thing to extract and estimate, so we're doing the best we can, but with the work we've done, we would say that this debt is absolutely skyrocketing. And that fact suggests that at any point, if the crypto market corrects, it will almost inevitably be a significant correction as buyers scramble and sell crypto to pay down leverage or margin that they might have on that. Crypto remains a market where millions have become rich, but it is one where buyers should especially beware. One other thing we want to say is we have a lot of charts in this week's video. We're going to start including those charts in the email we send you so that you can download it in a high-res version to use as you will for further study for other purposes. You can join our email list at join.tychosgroup.org. That's it for this week. Thanks.